Hey, folks, we are back. It's Inside Real Estate with Mike Kruizinga. Time for another mortgage segment with our resident expert in all things mortgage, Terri Waggoner over at Supreme Lending. Terri, how's it going?
Good morning, Mike. I'm doing good. How about you?
I'm excellent. And,
awesome.
Of course, by the way, folks, anytime you want to reach Terri, TerriWaggoner.com is the website, and her direct line, 469-644-4818. And so what are we going to get into today?
How about that, Mike? I kind of want to... I give out my cell phone number.
That's true. Yes, that is your cell phone number. So,
pretty awesome.
And it is
and
awesome.
I answer it.
And
That's
you do
even better.
That's
even better.
That's right.
So call.
So when you're in the car, when you're at the grocery store, whatever it is, you're going to answer the phone.
That's right. I cannot tell you the number of times I've been at the grocery store and I just have to pull over.
That's right, yeah.
Just park my cart.
Park the cart.
Take care of business.
That's right.
Go on about business.
Yeah,
all right.
Absolutely. Well, let's get into some mortgage talk here and get the folks some good info.
Okay, so today I thought we would talk about debt-to-income calculations. Folks probably have heard over and over and over us talk about debt-to-income ratio, or DTI. Mm-hmm. What does that mean?
Yeah.
What all is included in that calculation, and why is it such a big deal to your mortgage loan? Well, it's a big deal to your mortgage loan because it tells our underwriter what your debt is versus as it compares to your income. And we calculate all of your debt. And some folks tend to forget some of their debt that they may have. Right. So I kind of wanted to go over what's all included in that so that so that everybody will have a little bit better understanding on what we mean when we say your debt to income ratio on a conventional loan can't exceed 45%.
Right.
Okay.
And we're, and this is perfect because we're such a debt-ridden society,
yes.
and we do forget about a lot of the debt we have.
Yes, we do.
This is actually just a good process for people to think about in general.
Right. Yes.
To be
even
honest,
if you're not buying a house, you need to consider your debt ratio.
That's right. You really should.
Yeah. If you're having a problem paying everything, your debt ratio may be too high.
Too high. Yeah, exactly.
So we've talked about before how we calculate income, so I won't go into that. But the debt ratio does deal just exactly with how much debt you have as it relates to what your qualifying income is. And so things that are included in your monthly expenses, obviously any mortgage payments that you have, and within that mortgage payment, you don't have just the principal and interest. You have the taxes and the insurance and the mortgage insurance, if that applies,
right?
And HOA dues, if that applies. There's some other, sometimes there's co-op maintenance fees,
yeah, all
kinds of other fees that can be added into. So we have to make sure we have all of those accurate as well.
And they all add up.
Right. So then within your debt ratio, we've got your monthly housing payment, your installment payments. Typically, and this kind of depends on the payment itself, if you owe more than 10 monthly payments on an installment loan. So you bought some jewelry at a jewelry store and you've got 9 payments left and your monthly payment on that is $65 a month, we probably won't have to count that in your debt ratio. But same thing if you have a car payment and you have 9 payments left on it and your car payment is $650 a month, we are going to count that.
Right.
Because that's going to be significant as you begin your new mortgage.
Yeah, absolutely.
Okay. So we kind of have to take a look at that process and what all is left there.
Okay.
Then obviously any auto loans that you have, any installment debts, any revolving debt. Now, we have talked about before paying off debt to qualify for a mortgage. Mm-hmm. And this is kind of new. If you pay off, before we've always had to pay off a debt so that we can get the debt ratio down where we need it to be, but we've always required the borrower to close that account, close that credit card, and they don't like doing that. Right. Well, now we don't have to. As long as we can show it's a zero balance,
okay,
they're not required to close that credit card.
Good.
Okay.
I like that because, sometimes when you close that account, particularly if it's like one of those golden accounts that you've had over maybe 6-7 years,
right?
That's a good qualifying base on your credit report. It's a bummer to have to close that, and sometimes it goes negative on your credit report.
It sure can. So we don't have to do that anymore.
That's
good.
a
good thing.
I like that.
Then other things that can affect that is, what about those pesky student loans?
Yeah.
Okay. Everybody, I'm going to say probably 60 to 70% of the credit bureaus that I pull have student loans.
Right.
We should spend a whole segment talking about student loans.
Yeah,
but
easily.
Yeah, but student loans, if they are in deferment, we used to not have to count them on FHA loans, but we do now. Regardless of the loan type, if you have a student loan, even if they're in deferment, we still have to count that payment in your debt-to-income ratio.
Okay.
Well, what if there's no payment listed? We can do one of two things. Have the borrower call the student loan company that's servicing the loan and have them send us something in writing stating what that proposed payment is going to be, that loan payment's going to be. If they can't get anything, we have to take 1% of the outstanding balance. Sometimes that can be kind of hefty.
Right.
So most of the time, we're better off if we can get that actual payment from the student loan company, from the servicer. Because, they've got lots of really cool programs to put these folks on where they have graduated payments, and I've had some that have a zero payment. So if we get something from the student loan service provider that shows the student loan anticipated payment is zero, I can use zero.
Perfect.
Okay? So that's usually our better way to go.
Yeah. So there is a way around it, but in some cases, with this being that way now, I mean, it may push some of these buyers' time frame down the line.
Yes, I have had that happen over the last few months.
Making significantly more income.
Right. Yeah. So we have to take all that into consideration.
Sure.
Then another thing that people seem to forget, and not even necessarily forget, but just don't know the process in which we have to calculate it, and that is rental income. We've talked about rental income before, in the fact that a lot of folks think, well, I have a positive cash flow, so it's all good. My mortgage payment on this rental property is $1,000, and I rent it for $1,500. I have a $500 a month positive cash flow. No, you don't, because you didn't report it that way on your tax returns.
Right.
So we have to take a look at the tax returns and all the expenses that you wrote off on your tax return and determine what your cash flow is from that property. That has to go in our debt ratio as well. Okay?
Boo.
Yeah, I know it. I know.
I don't like that one.
I know. Okay, so here's one you'll like, though. All right, so let's say you co-sign on a car for your son.
Bad idea.
A bad idea. Don't ever do that, by the way. But let's say you've already done it.
All right.
But your son, responsible person, he's making the car payments. He's making them directly to the auto finance company out of his account, and it's a joint contract. That's the important part. If you have a contract written for the purchase of that automobile that has your name and the other party's name, and you can prove the other party has made the last 12 monthly payments, we don't have to include that in the debt ratio.
Okay.
Okay? That's the key part, though. You can't just buy it for him and let him pay it. His name has to be on that contract as well.
Okay.
Okay? And he can, it's a few more hoops for us to jump through. Best if he just pays directly, but if he's giving you the money so that you know for sure that it's getting paid on a timely manner, which is exactly what I would do, he can give you the money, have it in a traceable source, have him write you a check or get you a money order and make a copy of it, and it's the same amount every month that you are depositing into your account and then immediately turning around and making the payment for the exact same amount. That's traceable. That's something we can show an underwriter.
Okay.
Okay?
And it has to be the exact dollar figure.
Yeah. So, or more, if the payment's $562.38 and he wants to pay $565, as long as it's the same amount and we can reasonably prove to an underwriter that payment that you put in your account and then turned around and made the payment. If it's reasonable, we can pass that on to the underwriter.
Okay.
Okay.
Very good.
All right. Let's see what else. Schedule C losses. So if we've got self-employed borrowers that have Schedule C losses on their tax returns, we have to include that in the debt-to-income ratio. There are some calculations that we can do on the Schedule C to kind of add some stuff back in and take it back out, and we have a whole formula that we have to do for that. But if you've got Schedule C income or loss on your tax returns, we have to take that into consideration.
Sure.
Okay. If you, let's see what else. I think that's all the notes that I've taken. But yeah. So we just have to take basically looking at your tax returns. Mm-hmm. That is the most important thing. Looking at the tax returns, looking at your paycheck stubs. Oh, I know what else I forgot. Knew there was something else. Child support.
Yes.
Yes.
That's a big one.
Yes, that's a big one. So if you are making application with a mortgage lender, do not forget to tell them you pay child support. That's a big one, and that can really come back and bite you.
Yeah, because it is going to be found.
Right.
So, it's just going to ruin the deal down the line if you don't tell us up front.
Right.
And that reminds me of a funny story I had last week. I had a gentleman call me, makes really good money, had a really good credit score. Man, I thought this call was going really good. Hey, this is a potential good buyer. We can get him out there going.
Right.
I asked him about, the wife, is he married, etc. Well, yes and no. He has an ex-wife, but is actually technically still the wife. They've been split up for 9 years.
Oh, my goodness.
He is paying child support, but not through the system. He's paying it on the side. And the new wife, who's, I guess, not technically a wife yet.
Oh, wow. This is getting fun.
Yeah, is just a housewife, so we can't use her to buy the house.
Right.
So, it's one of those stories where, it was going really well, and then all of a sudden went totally downhill.
Uh-huh.
Well, here's a thought. You need to get divorced,
right.
And you're going to need to deal with things so that maybe at some point you can buy a house, because right now his only option is renting.
Right. And let me tell you how an underwriter's going to find that, Mike, because you just got through saying it's going to be found.
Yeah.
Okay, so this is being done completely off the books, but he has to take that money out of his checking account every month.
Yep.
Probably at the same time.
Mm-hmm.
And we have to see the last 2 months' bank statements. And when an underwriter sees that on the 15th of those 2 months, he paid someone $900, what is this for?
Yeah, where's that going?
Where's it going?
What's going on there?
So it will be found. And that's part of the reason, not the only reason, but part of the reason why that's part of the documentation that we have to have is the bank statements, just so we can see what are you paying on a consistent basis out of your account so that we can determine if we need to add something to the debt ratio.
Right. An important thing for folks to remember is look, since the 2008 crash, there's a lot more restrictions. Things are kind of, in some cases, they're opening up a little bit, but in some cases they're tightening up a little bit. But at the end of the day, since it's not pre-2008, everybody just needs to kind of have their ducks in a row. And but the main thing is, call Terri. We'll walk you through everything and take care of, what you need to do with your debt. Maybe you need to pay off a credit card here or pay off something there. The good thing is you don't have to close it now.
Right.
And, we'll get you all squared away and get you in the position where you can buy a house, and we'll get you taken care of.
Right. And we've talked about this too. Sometimes when you call those mortgage lenders that are online, they're not taking a complete application.
Not at all.
And it is so important to we just had our office meeting about that yesterday. It is so important for us as loan officers to take a full and complete loan application to eliminate or minimize any issues that might come up later in the process.
Right.
Because they certainly can.
Yeah. I mean, trust me, folks, you don't want to go and just do something online or call one of those random 800 numbers. Terri's right here in the DFW area. She wants to take care of you. She's well aware of everything going on here in the DFW market and Texas real estate. And, why wouldn't you want to talk to somebody that's here and local and that's going to go through the process of figuring everything out for you, whereas you're just going to get a quick, 1 second, 2 second answer from somebody on an 800 line somewhere else in some other city and some other state, and you're not going to get the information that you need.
Right.
So highly recommend give Terri a call. Her direct line, by the way, this is her cell phone number, 469-644-4818. And, of course, the website, terriwaggoner.com, terriwaggoner.com. And anything else we got? Parting words?
Since we're using a new website.
Yes.
Terri Waggoner, like the Waggoner Ranch.
Correct.
Waggoner.
Yes. Waggoner.
Waggoner.
Terri Waggoner.
There you go.
There you go. TerriWaggoner.com. Folks, we've had another great mortgage segment. Hey, folks, Inside Real Estate, Mike Kruizinga. Come on back in a few.